But first, the economic data out today. Inflation falling to 7% in the March quarter. It's a good drop, but in historic terms, 7% is still double what it should be. The Reserve Bank will, of course, still be worried. They meet next Tuesday. So what's that mean for interest rates? Joining me now, Sky News Business Editor Ross Greenwood. Well, what did you make of the numbers today, Ross? And as I said, this drop, yes, it's good. It's better to be 7% than 11%, but we're still way too high here, aren't we?
We really are. So you talk about the inflation rate at 7%, underlying inflation, which the Reserve Bank looks at, strips off one-off factors, 6.6%, and the cash rate 3.6%. So the United States expected to raise interest rates in the coming month. That'll take its cash rate above 5%. Its inflation rate is falling to 5%. It's further along the line, but you're supposed to get the cash rate and the inflation rate close together. But here the Reserve Bank says it wants to sort of, if you like, almost glide our economy into getting the inflation rate back to 2 to 3% within 2 years. This is the idea to try and save more Australian jobs, which is noble. But the interesting part about it is Jim Chalmers last week said he thinks that full employment in Australia is around 4.25%, which, given the fact it's 3.5% right now, means that you could probably go harder trying to crush this inflation very quickly, even if it means raising the unemployment rate. But we actually already know that there's lots and lots of job vacancies out there, and there's simply, at the moment, not enough people to fill them.
Right, give us a sense of what's the main factors contributing to the data today, and what do we need to focus on to drive it even lower?
Building a house, that's number one, right? You know, the price of that's gone up by 15% in the past year. Airfares, they continue to rise. But do remember, even if airfares stay exactly where they are, so you're still paying sort of 25, 40% more than what you were pre the pandemic, the fact is that's non-inflationary in the future. So that's the other thing. It's only things that are still going up. The problem is in our economy right now, even though I heard the Prime Minister say today, well, you know, the inflation, it's partly because Russia invaded Ukraine, oil prices went up. Well, oil prices did go up, but then they came down. But now they're starting to rise again, so fuel prices will start to rise. Other things, including, say, the services industry, and this is really important because as soon as you start to get the inflation creeping in to the services industry, it's escaped, if you like, pure commodities and products that we buy. And so as a result, it doesn't necessarily come down as rapidly as it otherwise might. And that's a problem for government, and that certainly is a problem if you want interest rates coming down anytime soon.
I tell you, the PM, that the Ukraine excuse is the dog ate my homework sort of stuff, and exactly. I think it's about at the end of being a legitimate economic example to give us. RBA meeting next Tuesday. Are we going to see rates rise or perhaps another pause?
No, I think they're going to be on hold. And the reason is not necessarily that I don't think that they should rise. I personally think they should. I think you've really got a chance to crush this inflation with the higher interest rates, to change behaviour, to change habits. I don't think that's the Reserve Bank's strategy. I think really they're going to say that they'll sit back and look at the data for a little longer to see what happens. But I do get a sense, if they wait too long, that really the longer-term problems for Australia's economy and the chances of a hard landing for Australia's economy if inflation does take off, wages start to rise, the claims from the ACTU start to get up, I think that's where Australia economically has got some real problems down the track.
Ross Greenwood, thank you.